Hi, my name is Jordan Wilson. Today we're going to finish our look at things you should consider when assessing a potential financial advisor. And we'll finish up with a look at the advisor compensation, some of the general types of compensation arrangements you'll see. So we've already gone through technical qualifications. We've considered experience of a potential advisor, the personal fit, and now we'll finish it off with the fees. The first fee arrangement you'll see out there is commissions, or what I would call retrocessions at times. And that's where you purchase an investment product, you receive free advice, but you're paying for that advice through either a front load, back load, or declining sales commission. And then there's ongoing retrocession fees to the advisor or the advisor's company that are built into the management expense ratios. Now, the first big advantage of using a commission salesperson is you get free advice. And that is often very good for very small investors, those who are just starting out, because there's nothing out of your pocket. If you go with a no-load fund, every dollar that you invest starts to grow on your behalf. We also have seen a shift away from front-load funds to more no-load funds. And part of that is building in fees on an ongoing basis, or you're seeing more funds being used by percent asset under management institutions or advisors. So there's a definite shift from front load to no load. So your odds of being able to buy a fund and start investing all of your capital is pretty high. Another, let's call it an advantage, is invisible ongoing fees. So every year you're paying a management expense ratio on that fund, and that's going to include fees paid back to the advisor or the asset managers, marketing, admin, all this stuff. But it's just deducted from the fund itself. It's not like someone's calling you up and says, hey, you've got to cut me a check for $1,000 because this is the expense ratio for the year. And for many people, if you don't actually see the fee and have to pay it out physically, it's invisible and it's less of an issue for many people just from a behavioral finance perspective. Another potential advantage of commission salespeople is that you're seeing much stronger technical advisors. And the reason for that tends to be that there's so much increased competition in financial planning, in investment industries, between fund companies, between the banks. And so you can't just go out and say, this is my fund, and sell it to somebody. There's got to be, as they would say, a better value proposition for the client. So many fund companies actually ensure that their employees are, or their independent advisors are competent in what they do. So you may be able to actually find a very strong technical advisor with excellent credentials when we discuss the technical qualifications and not end up paying the full price for financial planning or other services. So that's an opportunity. It used to be that most maybe all fund salespeople sold in-house proprietary products. And again, what you're seeing more is because of the competition, that there's an increase in using non-proprietary products, what I call best of breed. So they go out and maybe I work for Primerica or Fidelity or somebody like that. It used to be maybe I only sold those products because that was my business relation, either as an employee or an independent commission salesperson. But now there's a slightly increased opportunity to bring in external products. And that's not a universal, so you need to look around and identify, because obviously the more choices that you have to invest in, the better for you. And I think part of this is that firms aren't altruistic. You know, they're there to make money, and that's fine. But they also realize that satisfied customers are going to bring more wealth to their company over time. So I can make a quick sale of a crappy mutual fund, have an unhappy client for a few years, and then ultimately they leave and never come back, or they badmouth me to their friends. Whereas if I have better service, both in the quality of my advisors and my offering, then that may bring in additional net new money and assets from that client. You may have the word of mouth advertising. And all these things sort of go together to be a bigger driver of long-term profitability and revenues for the fund company or the bank than just that short-term sale that you end up losing the business in 5 or 10 years. So there's that acknowledgement that even though we're selling you a product, we're trying to look to the long term. So again, those would be the advantages. The big disadvantage of commission or free advice is that it's not really free. You may pay a load to buy or sell the product. You may not. There may be no load. But you're always going to pay ongoing retrocessions that are fees buried in the management expense ratio. And often what you may find, if you look, that there'll be a different management expense ratio, MER, based on what class of product you bought. So if I bought a front load fund and I'm paying the advisor up front for that, then maybe I'll see lower ongoing fees. Whereas if I buy a no load fund where I'm not paying the advisor or the fund company anything up front, then perhaps I'm paying higher ongoing fees. So things to look at is, what am I paying up front and over time? And we look at some of the numbers, what you'll tend to find is that if you're buying a load fund, holding that fund short term on a front load or even a back load tends not to be a winning proposition. You're better holding the fund for longer periods. However, the longer you hold a fund, you may be paying 0.5 or 1% every year. So it's just ongoing. Another con is perhaps it's primarily or totally in-house products. So maybe Vanguard or Fidelity or BlackRock has lower cost, better return funds. But if I'm using a bank or a fund company that doesn't allow me access to better performing products, that's a cost. And again, when we look at the fees on a couple of examples, we'll see that in the medium to long run, that free advice can get costly. I think the issues I'd probably consider if I'm meeting with a potential commission or fund salesperson is, are they a fiduciary? And a fiduciary is there, it's a technical term, that the person is acting solely in the best interests of the client. And often with a commission situation, I always sort of like, okay, whose interests is this person working for? Because their compensation is, yes, indirectly coming from me as the client. But if I'm faced with two funds and one gives me 1% per year in an ongoing fee, and the other one gives me 1.5%, that's a big difference in revenue in my pocket as the advisor. So is that more expensive fund in my best interest, or is it in his or her best interest? Similarly, if I work for a bank and I'm advising you on mutual funds, and I work for RBC or Bank America, is the RBC or Bank America mutual funds the best? Why are you promoting that fund to me? So you got to look at, why isn't that Bank America or RBC employee suggesting I buy a Fidelity fund? So again, you've got to just look at what they're offering and wonder whose interests are being best served or solely served. And I always ask the question, who cuts the checks? If I cut a check to you, there's a good chance that I'm there and you're serving my interests. But if the guy's getting compensated by RBC or Bank America, regardless of legal terms, where does that person's loyalty truly lie? So again, I always look at who compensates your advisor, and that gives you a clear hint as to who, once you get past all the technicalities, who they truly serve. The other thing is, if you're working with commission advisors who are providing other services, and many of these firms are now bunching in financial planning and estate planning and things like that, is, okay, are they primarily a fund company to sell product, or are they truly financial advisors? So even though there's some strong advisors out there and the fund companies do want to provide a good overall service, you've got to ask yourself, again, is this a strong advisor that I'm using, and not, oh, I'm getting advice for free, because in the long run that can cost you. The next fee arrangement we'll look at is percent assets under management. And that's a relationship where some may call it a wrap account, where I pay an annual fee that's based on the assets under management. And often there's some flexibility as to what's considered AUM, but we'll say it's just the bankable assets in the portfolio you have with that bank or that financial institution. The pros of this are, it's transparent, yet it's also invisible. So if I cut a deal with Bank America, where they're going to charge me 1% of my portfolio with them, then if my portfolio is $1 million, I know what my cost will be on an annual basis, 1% of that. I may not know what my fees are going to be through ongoing retrocessions with a commission, because that can kind of fluctuate based on other factors. But it's also a bit invisible in the sense that it's just often taken out of the account, so you don't really maybe feel the pain as much. And the other thing that's good with this, which I list a little bit lower, is that often it encompasses a variety of fees. It's not just asset management. So maybe I'm getting a free checking account. Maybe I'm getting a free MasterCard or Visa. Maybe I'm getting free wire transfers or half price on wire transfers. So there's other fees that may be built into that holistic 1% per annum that I'm paying for what they call assets under management. Another advantage, I think, of this model is that the goal of the advisor is to increase the assets under management. So they prosper if you prosper. If your wealth is $1 million and they can come up with an investment program that gets you to $2 million in 5 years, suddenly they're making twice as much revenue off you for the same service. So there is that connection between the advisor and the client as far as their goals of increasing your wealth. More and more of these advisors deal in non-proprietary investments. So all they're concerned about, again, is getting your assets in and charging you a percentage on them. They're less concerned about, okay, I can only buy Bank of America products, or I can only buy RBC products. No, they want your money because that's what they're making their profit off, is the assets, not specifically what the investments you're making are. So that's often considered good. Another advantage is that you can negotiate fees to some extent. And that's where I sort of say, the flexibility on the terminology. Maybe I've only got a portfolio of $1 million with RBC, and they're charging me 1% for that. But the advisor knows that I've got 5 million sitting with TD, and she wants that transferred over so that she can start making her own money off it. So I might say, well, that 1% is a little steep. Maybe if you can go down to 0.8, I'll bring over another million or two. So that's something to look at. Other people look at, this person's an entrepreneur that runs a plumbing company. They're in their 50s. There's a good chance that in the next couple of years they'll want to retire. And if they don't have children to pass the firm on to, or internally where it's a succession, they may be selling the business. So if my plumbing company has a fair market value of $3 million, maybe I can use that to say, hey, in the next 5 years, I'm going to sell this business. Why don't you give me a break, because there's a good chance I'll bring that money in. So there's lots that you can do to have some flexibility on the fees. There's a lot of, I like percent asset under management. I'm not a big fan of commissions, but I don't mind this model. But one of the negatives is usually that there's a minimum asset requirement. So that's a consideration. If you've got 100,000 or 400,000, you may not be able to get this service. And in Saskatchewan, where I'm based, often that cutoff point is sort of the million, maybe 2 million mark in assets. And when you consider the retirement savings plans and things like that, that's less onerous in today's world, but it's still a bit of money for a lot of people. The other con might be that even if you hit that minimum level, you're going to pay a higher relative percent than someone with more money. It's that economies of scale type thing. So if I bring in, 2 million, then I might get a deal as opposed to just 1 million. And I think if I look at some of the statistics, for example, advisor headquarters in 2020, the average percent AUM, and this would be US data, if you brought 100,000 to the table, you're paying 1.12%, which is $1,100 a year. If you bump that to 500,000, it's 1.05, a million, 1.02, 2 million, 0.91, 5 million, 0.84, and 10 million, 0.69. So the more money you bring to the table, the less that you're paying on a dollar per dollar basis. That said, if I bring 5 million bucks in and I'm paying even 0.84, that's $42,000 a year. I need to assess, am I getting value for that? And that's an issue as well, as your assets grow, this can actually get fairly expensive. And sometimes you may not feel it because it's that marginal utility where I might feel $100 fee if I've only got 1,000 in the bank, but I might not feel 10,000 if I've got 500,000. And that's kind of one of the things that the banks like with the assets under management approach is it's invisible in that sense, and you can maybe charge more than market would bear if someone went in on their own and said, I want this, this, and this. And if you told them 42,000, they'd laugh at you. But as it just sort of grows organically over time, less of an issue. The other thing you're going to find is that the service level and the quality may vary based on your assets under management. And an example there would be, excuse me, let's say Wealth Simple, which is more robo-advisor type business model. But they've got 3 different types of percent asset management. The basic, if you have under 100,000, you pay 0.5% per annum. That gives you a portfolio, it's a little bit of advice, automatic rebalancing, auto deposits, and dividend reinvestment programs. Now, some of that sounds interesting, but I mean, everyone, your bank account has auto deposits and dividend reinvestment options. So it makes it sound impressive, but yeah, not sure what you get for 0.5 except for a portfolio that within certain limitations meets your objectives and risk tolerance. However, if you go over 100,000, the fee drops to 0.4. And that gives you a financial planning session, some tax efficient funds. So a little bit cheaper and a little bit upscale as far as the service level went with the basic. And then if you have over 500,000, it's still 0.4, and you still get everything that came with the black and the basic. But now you also have a dedicated advisor team. You get some financial reporting. You get a more individualized portfolio. You get discounts on some health care. So again, the more money you're bringing in, the more service level and the more personalized the attention. So again, if you're not bringing a lot to the table, maybe you're not getting the quality that you could get through a different advisor relationship. And at times you might still see fees embedded in investments. So you're paying a wrap for the actual external fees, but depending on the product, there's still going to be management expense ratios built into a lot of funds. Now, one thing that we covered when we looked at management expense ratios themselves is that there's different classes of funds or investment products, and that if you have a percent AUM, then often you're going to have a discounted MER versus other share classes. But you need to verify that to see, am I getting a break on internal fund fees or not? I think the issues, to me, know what fair market value is when negotiating. So, do some due diligence. If we look, again, US data, but last year, Forbes magazine, their view was that most percent AUMs are between 0.75 and 1.5%. Now, I just mentioned Wealthsimple down at 0.5 and 0.4. And what you're seeing there is the robo-advisors are starting to put some fee pressure on these percent AUMs. So I would expect over time, much like when iShares and Vanguard went heavy into the ETF market, that resulted in downward pressure on mutual fund fees. And I think we'll see the same thing here with percent AUM fees, and or you'll see the banks counter by trying to add more and more services to offset the variance in pricing. I think the other thing you want to see is, what am I getting for that fee? I bring $5 million to a bank and I'm paying 0.84%, which is 42 grand a year. What am I getting for that? Am I getting alpha, outperformance by their asset managers that makes it worth almost 1% in fees? Am I using their financial planning services? Am I using other services that are wrapped in that price? So you want to make sure you're getting some value for that amount of money if you're paying it out every year. And then how much work is being done, which is a similar issue. Am I giving them the $5 million and they're putting it into a relatively generic managed portfolio on my behalf that just meets, maybe in more detail than the robo-advisors, but it just meets my objectives and my risk tolerance? Or are they sitting down and doing customized financial planning on a very detailed level? So is there value in the free services that I'm receiving? And for the ones that I do want, what's the quality, and how would that compare to if I went out to a professional financial planner on the street to do a customized plan for me there? Then final is, I would ask, are they a fiduciary? Are they there serving my interests? And that's kind of a yes or a no for them. Yes, I am a fiduciary. No, I'm not. Usually the no, I'm not, but. But it is a yes or a no question. And if they're not a fiduciary, I think that's worth thinking about as well. Fee-only advisors. Here I'm biased, obviously, because that's my business model. And that's essentially just where you're sitting down as if you're sitting down with your tax accountant, your lawyer, and you're saying, I want your objective, unbiased, hopefully expertise. And in exchange, I will pay you a certain amount of money, whether that be a flat fee based on the engagement or an hourly rate. You don't have to worry about minimum assets. I could care less if you've got $1,000 or $10 million. Now, actually, that's not true, and we'll get to that in a minute. But in theory, it's not asset driven, so no one really cares. Most, if not all, fee-only advisors would do best of breed products. I'm not on the payroll for RBC or Toronto Dominion or Scotia. So I don't care who you bank with personally. You could bank with Questrade, you could bank with RBC, TD, doesn't matter to me. And it doesn't matter what products that we put you in. All we're looking for is the best fit for your needs on a cost-effective basis. And likewise, there's no incentive for me to sell product. All I'm doing is providing expertise in exchange for compensation. Since I'm not getting any money from anybody else, I don't really care what we buy. And often, not always though, these would be true fiduciaries. You're paying me a fee for objective, unbiased advice, and I'm giving that to you. I'm not trying to say, if I put them in this product, maybe I'm getting a better commission, or maybe I've got quotas from my bank for net new money. All I care about is the client advice. And I think that's kind of another advantage, is that that's the only thing that a fee-only advisor offers. So their advice had better be good. And if it's not, then again, word of mouth, unhappy clients. So I think that's an incentive for fee-only advisors to stay current and try to be the best they can. Now, the cons, and the big con, is that you have to pay up front. You can't bury that fee over a 10-year period. So it can be expensive. And I think that, again, there's that sort of behavioral finance aspect where if you have to cut a check for $4,000 today, in some ways it's mentally more difficult to do that than to realize that over 10 years, you're going to pay 20 grand. So that's an issue, I think, a lot of times with fee-only advisors. The second thing, which is similar, is that often clients feel like they're on the clock. And again, it's the same with a tax accountant or if you're dealing with your lawyer. If I'm doing a percent asset management or a commission, I don't have a problem picking up the phone, calling that advisor and asking them questions and chewing the fat and just saying, hey, what's going on in the world today? But if you call up your lawyer or you call up your fee-only financial advisor, you're thinking, okay, that egg timer has just turned over and this person's billing me for every second that we talk and probably rounded up to the nearest hour. So that's also an issue. Now, I said up front here that I don't care about minimum assets. In my case, that's definitely not true because I'll decline a lot of small clients because it makes no sense for them. If you have $100,000 and I'm preaching cost minimization, it's kind of hypocritical to say, oh, okay, I'm going to charge you $5,000 out of your $100,000 for my services. That's just kind of contrary to cost minimization and passive investing that I espouse. So I tend not to work with smaller clients because of that. Now you can set up more cookie cutter portfolios for them, but you have to give less service to try to do it on a economic basis for them. So again, if you don't have a lot of money, you might want to check how you can get a fit with an advisor, but it can be difficult. Another area that's interesting is there's actually not very many fee-only advisors out there, which I didn't really realize until I started looking at some statistics. There's becoming more of them because what we're seeing in the overall investment community is this shift from the regulators to want advisors to become true fiduciaries. And I'm not quite sure how they make that transition in the world we live in today, but that's kind of the desire. And we are seeing more and more people going that route, but it's still relatively low. Like here in Saskatchewan or Saskatoon, there's not very many that I can think of. And I think the final con is, like any industry, you're only as good as the expert giving advice. And so if I'm competent, great. If I'm not competent, then you're at risk. So you need to do your due diligence on my technical qualifications, my experience, my personal fit. And that's more important than the fee arrangement. I'd rather have a trustworthy, highly competent commission salesperson than a poorly trained fee only. So things to look at for the cons there. The final issues I would look at are, again, fiduciary. All of these, you want to find out, who do they serve? Is it you as the client? Is it their employer? Is it commissions on product sales? And the second one is, again, like the asset under management, compare rates. And the problem here a bit is that, on the one hand, I've got fees are comparable to a lawyer or a tax accountant. And I mean that kind of price-wise, but I also mean it skill-wise. If you go in and you're dealing with someone that's just got called to the bar, they're going to be relatively less expensive than someone with 5 years experience who works for a bigger law firm. And then again, if you're working with a tax partner at KPMG or one of the big accounting firms, you'll pay more on an hourly or an engagement rate than you will for someone that just finished their in-depth tax course and placed their shingle out on their own. So again, you're looking at apples to apples in the sense that the more experienced, the more qualified a fee-only advisor, and there's going to be a higher charge for that. So just again, beware. And I think from a 2020 Kitsy's median hourly rate, they're kind of looking on a median basis in the US, fee-only advisor, about US dollar, $250 an hour. But again, that's median, and that takes into account young, new, less experienced, less qualified, as well as the higher end. So you're going to see a lot of variance in that. So I would sort of go back to, in your local area, what does a competent estate lawyer or a tax accountant charge? And then figure out where the advisor is in that sphere. Here's a fee comparison, also from Kitsy. And again, that's that $250 hourly median in 2020. And sort of they have it ranging in the top 10%, about 150, 350 on the higher side. And again, US dollars. What's interesting on this slide is in the left box, for someone with $1 million in assets, they're probably going to pay 10 grand a year for their services with the advisor and whatever else is provided for free. A standalone might be 2,500, and someone with an hourly plan might be 1,800. So again, it's hard to tell what sort of services come with that, but you see that you're paying a nice premium for that wrap account where you're paying the one fee to cover everything. And you have to ask yourself is, am I getting $7,500 or $8,000 extra value from that fee, asset under management, where I'd be saving money if I did it on a fee only or standalone basis? Got a couple of slides here from the SEC, the US regulators. And this just kind of shows the impact of fees on portfolio growth. And what you see here is that fees eat up your profits over time. And in the first slide here, they're talking about 0.5% in annual fees reduce a portfolio over 20 years by $10,000 compared to a portfolio with 0.25% fees. So just 25 basis points difference, 1/4 of 1%, which seems like nothing, will reduce your portfolio over 20 years by 10 grand. We just talked earlier about the percent assets managements being sort of in that 1% category. Here we're talking 25 basis points, how it can add up. And we see here in the next paragraph that in 20 years, 1% versus 0.25, so a 75 basis point delta, results in 30,000. So again, fees add up, and the longer that they accumulate, the worse it gets. It's the negative of compound returns. And if you're sitting there going, wow, I'll do a lot better than 4%, maybe you will, maybe you won't. If I look at from 1999 to 2018, a 20-year period, annualized annual return for the S&P 500 was 5.6%. For US bonds, just aggregate, 4.5%. A 60-40 stock bond split, 5.2%. And then if you factor in inflation of 2.2%, suddenly that 4% annual return doesn't look too bad, and definitely not out of line with what the typical investor makes in their portfolio. And if we go back to 1957, which is when sort of the S&P 500 became 500, it's only running about 8% per annum just for stocks over a very long time period. So if your portfolio is expecting returns of 5 or 6% for your equities, then you have to really, really ask yourself, is 1% per annum in fees, is that, good? In this illustration of ongoing fees over 20 years, again, what we see here is that there tends to be a large delta between higher fees and what you lose. And in this case, they're actually looking at, okay, that 1% annual fee would cost us 28 grand on $100,000 over 20 years. But then, and again, we look at this with compound return. I can't reinvest that because I'm paying somebody else. It's not accruing again on my behalf. So I lose another $12,000 that will accrue actually to the fund company or to the bank, not to me. So again, that's an issue. This one is kind of a quick comparison between embedded versus flat fees. And what I tried to do here was you invest $100,000 initially. Each year you add $18,000, so $1,500 per month. And we're assuming an 8% portfolio return, which, as we just saw, is very generous. But that's what we'll assume. Now, if we assume that you're paying, in the middle column, 100 basis points or 1% per annum in fees, your net return, instead of 8%, is now going to be 7%. And if we go down to the middle with the red columns, we see that 7% net return is going to accrue over 20 years, $1.1 million. But if we didn't have to pay that, it would have grown substantially more. And my comparative here is, instead of paying nothing, but paying higher expense ratios over time, you're paying a flat fee advisor $3,000 or $4,000 or $5,000 for that initial portfolio construction. And then you're off to the races. And every year you get the full 8% because you're not paying fees. So if you pay a flat fee advisor $4,000 for their services, that will grow over 20 years to $1.271 million. And if we go down to the delta in growth, we see that is a difference of, over the 20 years, of $146,000. And if we're at 30 years, the difference is $500,000. So just by paying slightly higher expense ratios every year, whether that be percent asset under management or via higher management expense ratios on commission products, that grows to a huge, huge amount over time. Now, one thing you want to factor in that's not in the first slide is, with a flat fee advisor, I probably would recommend that you sit down with him or her on an annual basis or biannual if it's a very low risk portfolio, and do a portfolio review and maybe some modifications if necessary based on changes in your life. So in this slide, I assume here that every year you meet with the advisor and he or she charges you $1,000. So, a couple hours, maybe even 3 hours worth of work. Here, because you're paying sort of an ongoing fee for additional services, over 20 years, you're down less of a difference, but you're still $100,000 better off by paying the money up front and not paying it on an ongoing basis over 20 years. And over 30 years, you're still at $430,000 better off. If you want more work done and it's going to cost you $2,000 a year to sit down with your advisor, again, you're still better off, $55,000 over 20 years, $300,000 over 30 years. So even if you're meeting on a periodic basis with your advisor throughout those time periods and they're charging you, it's still better off than paying an annual fee. Okay, I think that's enough for today. Long session. But I think it was a good session because we covered the three main types of fee arrangements. And when I say main, what you might see out there as well is hybrid situations, combining those or slight deviations. Maybe a fee-only advisor is also making some money on retrocessions or referral fees for recommending you to a tax accountant or something like that. The key is that there has to be disclosure from that advisor as to what sort of revenues they're making from providing you various services. I think some of the keys that we discussed today are: take a holistic, a long-term perspective on your fees. You may not be paying a fee today for financial advice, but if you end up in a mutual fund, you'll be paying that fee embedded over 10, 15, 20 years, as long as you own that fund. And that can add up over time. You received one bit of advice in 2020, and you could be paying for that continuously until 2050. Whereas again, with a fee only, maybe you pay $4 or $5 grand today, but that's done. That advice is finished and received, and you don't pay for it throughout time. I think another area is understand what you're getting for your fee. If I'm spending $42,000 a year for my percent assets under management fee, I'm probably getting a bit of work for that, but what is it? Is it of that value to me, or can I get the same services a la carte from a variety of other vendors? I think those are key. And then the final point, or the final 2 points, are figure out whose loyalty the advisor is with. Are they a fiduciary? If the answer is yes, that loyalty should be to you as the client. If it's not, how does that impact the advice they give you? Is there a potential conflict of interest over selling funds that give them better commissions? Are they under pressure from their employer at the bank to sell in-house products or to increase their assets under management and achieve net new money for the bank? That may affect their compensation, their bonuses, their chances for promotion. So again, where are their loyalties? Who cuts their checks when they get paid? Is it you? Is it the bank? Is it a mutual fund? And I think that's probably going to be it, except for the fact that, as we said before, get everything in writing. That way there's no misunderstanding, no confusion. You know what you're paying for and what you're receiving in return. And that also sets the template for the work going forward. You know what's going to happen down the road in this arrangement. So again, get everything in writing, and if someone won't give you it in writing, then to me that would be the deal breaker, and I would recommend walking away. Because if someone won't put down a pen on paper what the relationship is, then it may not be worth pursuing. So thank you very much for your time today, and we'll be back with some more investing topics in our next session.